Good afternoon and greetings from Colombia. I am Alejandro Useche, an associate professor of the School of Management at Universidad del Rosario, located in Bogota. It is a pleasure and an honor to be with you today. Congratulations to the organizers of the 5th Global Congress on Climate Change, and special thanks to Dr. John Karen for the invitation and all the kind support. Today, I will share with you a recent research that I made with my colleagues Marta Sanchez Sancho, Jennifer Martinez Ferrero, both from University of Salamanca at Spain, and Emma Garcia from Universidad Politécnica de Cartagena, also from Spain. This research is entitled Socially Responsible Investors and Corporate Resilience to Climate Disruptions, Agents of Change or Passive Participants. I want to start the presentation with a quote by Feike Sijbesma, an internationally recognized business leader and current member of the board of World Economic Forum. Companies have power. Companies have impact. If you have power and impact, hopefully you also take the responsibility that goes with that. And talking about climate change, I think that this is a quote that goes for each one of us. We have the power and we can have impact on climate change. So I know we will take the responsibility. Our research investigates whether the ownership of huge institutional investors that sign the United Nations Principles for Responsible Investors, that we are going to call socially responsible investors, enhances firms' resilience to climate shocks. For this research, we used a database of 600 European companies in the period 2018 to 2022. Findings support this argument and highlight the potential of these huge institutional investors to promote a sound corporate behavior in front of climate risks. Of course, our research has got some limitations as we studied only firms listed in European exchanges, and our measures of climate risk were based on media coverage and on previous scientific methodologies. Climate change is one of the largest risks that humanity faces today, not only in terms of the huge environmental impact, but also because it is a challenge to global economic stability, with far-reaching implications for corporate operations, for financial performance, and for capital market behavior. We're going to understand by corporate climate risk the vulnerability of firms to climate-related disruptions that can impact operational continuity, asset values, and of course, financial performance. It is stated that firms are exposed to two climate-related risks: physical risks and transition risks. Physical risk is divided into acute risk that comes from a particular climate event, such as flood, wildfires, storms, and chronic risk that is related with more permanent changes, such as rising temperatures and sea levels. Both risks can damage corporate infrastructures, can have a negative impact on supply chains, and can increase transportation and insurance costs, reducing companies' sales, and profits. Sectors such as energy, agriculture, construction, and tourism are especially vulnerable to these risks. Transition risk is associated with changes in policies, technologies, or consumer preferences as a result of adjustments required to shift to a low-carbon economy. And it also implies a special reputational risk for companies. Aware of these risks, in 2006, a group of institutional investors, along with governments and civil society, supported by the United Nations, developed a set of 6 recommendations called Principles for Responsible Investment to incorporate environmental, social, and governance criteria into decision-making. This approach is known as socially responsible investment. When a company becomes a signatory, it must apply the 6 principles and comply with 3 commitments. First, to establish and execute an investment policy in which at least 50% of the assets under management meet the ESG selection criteria. Second, to delegate a team to implement their responsible investment policy. And third, to carry out oversight and accountability of this investment policy by the company's senior management. Institutional investors that become signatories of United Nations PRI and that apply ESG criteria for investment selection are called socially responsible investors. They are characterized by 3 elements. First, they have access to superior information, analytical resources, and expertise in evaluating sustainability risks. Second, they show an active engagement with corporate management in order to improve ESG performance and disclosure. And third, they have long-term horizons combined with duties that align with regulatory frameworks and stewardship principles. Most of scientific literature supports that higher levels of social responsible investors' ownership are associated with both superior environmental and financial outcomes in a virtuous circle. These improvements are often driven by larger investments in social and environmental initiatives and stronger corporate governance, which can lead to cost reductions, product differentiation, entry into new markets, and reputational gains. In this context, scientific literature has shown how there are climate risks, hazards, but also opportunities. For corporations, there are hazards as lower profits, financing barriers, and higher costs of capital. But there are also opportunities in terms of promoting green innovation, climate disclosures, and sustainable managerial strategies. Also for financial markets, there are hazards as lower return risk ratios, lower market valuations, and higher volatility spillovers. But there are opportunities such as green asset development, weather derivatives hedging, and enhanced reputation. Based on the previous ideas, and with the purpose of studying climate risks and financial aspects, our research team proposed a hypothesis. Firms with higher levels of ownership by socially responsible investors exhibit greater stock resistance to climate-related risks. To test this hypothesis, we constructed a database that included all the 600 companies of the Stocks Europe Index from 2018 to 2022. We took information from Refinitiv Econ, United Nations PRI, Climate Change Performance Index, and Reuters News. In order to calculate transition risk and physical risk for this set of 600 European companies, we use the Bua et al. Methodology. So we analyzed daily news, articles from Reuters News, compiling documents to create a time series that tracked the frequency of terms associated with transition and physical risks. These coefficients capture shocks or sudden fluctuations in the discourses surrounding climate risks. As the next step, we ran regression models where the dependent variable was transition risk and physical risk as a function of the percentage of ownership by socially responsible investors. That was the most important independent variable. We also included a set of control variables that took into account firm level factors such as profitability or leverage, with stock market indicators such as volatilities in the price of the stocks and the turnover of the stocks, and finally governance characteristics such as the board size or the percentage of independent board members. To address potential endogeneity concerns, we conducted an initial robustness check by using instrumental variables technique. Specifically, we employed two-stage least squares and generalized method of moment regressions to account for the possibility that socially responsible investors' ownership may be endogenous. We found that firms, on average, exhibit a greater exposure to physical than to transition risk. When we analyzed the results, we found that firms with higher levels of ownership by socially responsible investors showed lower sensitivity to climate-related events. So it seems to support that socially responsible investors possessed distinct attributes that enhance their ability to influence corporate responses to climate risks. In a further analysis, we investigated the differential effect of heterogeneity amongst socially responsible investors regarding their geographical origin and their investment horizon. So we found that greater equity ownership by European socially responsible investors is associated with lower climate risk exposure. What does it mean? We concluded that European investors tend to be more committed to climate-related concerns, likely driven by more stringent environmental regulations and normative climate frameworks in Europe. In the second further analysis, we divided the socially responsible investors in two groups, depending their investment horizon. In the first group, we took just hedge funds because they use more aggressive strategies to generate higher returns. And in the second group, all the other socially responsible investors. We found that firms with greater ownership by long-term socially responsible investors tend to manage climate-related risk more effectively. As conclusions, our findings let us confirm the hypothesis, and is that greater ownership by socially responsible investors is associated with increased resilience of firms' stock returns to climate-related risks. Second, the ownership structure matters. It means that socially responsible investors are not just passive capital providers, but they are active participants in shaping firms' capacity to manage climate-related disruptions. Third, the influence of socially responsible investors is conditional on factors such as regulatory and climate policy context of the investor's home country and on their investment horizon. Finally, we want to highlight the relevance of including sustainability and climate criteria in investment decisions and the need to shape corporate climate strategy, monitor risk exposures, and demand accountable ESG practices. Thanks a lot for your attention, and we hope that you have enjoyed this presentation.